So the basics of it is, if you live in a home and if you live in it, use a home as your principal residence, and you own it, 2 out of the last 5 years, you get $250,000 exclusion against gain. I want to jump right in. So section 121 exclusion is to waive 250,000 per person, up to 500,000 between a couple. You can use multiple. Let's say there's 3 owners on it, and each person lives there, owns it, and uses their principal residence. You can have 3 section 121s on a house. You can have 4 if they all qualify. So the 250,000 is per person. So that can come into a planning point as far as potentially adding somebody to title. I've had situations where there's a kid. Normally, we recommend not to add people to title, but sometimes you can use section 121 to put some of the gain onto another tax return, wait out the 2 years of ownership and use, and then get an additional $250,000 on that third or fourth, depending on how many you add on to it. So the basics of it is, if you live in a home and if you live in it, use a home as your principal residence, and you own it, 2 out of the last 5 years, you get $250,000 exclusion against gain. Now, those are the simple terms of it. Now, the 2 years, the way they break it down is 730 days or 24 full months. Now, they don't have to be consecutive. So somebody could live in it for a year and then move out, move back in 2 years later, get there another year. They don't have to be consecutive. I try to keep it on the months. So they say 24 full months. So you really don't want to get into calculating they had 3 days out of the month in it and then another week here, 2 weeks there. That may not hold up in audit. So you really want to have the 24 full months and be able to show that it was their principal residence for those full months. One of the ways that we do that as well, just to try to make things look good for appearances, is I'll use it as their tax return address, even if they're about to sell, and then 2 weeks later, let's say it's mid-year and we're filling out their 2022 tax return, but they sold it in 2023. I'll still use that address even though they're selling it right now, and then a month from now file a change of address. So I don't want to use, they may have already sold and moved, but you want to make sure that tax returns, the address is on the tax return as their principal residence. It just holds up better, as opposed to if you have a different return, or sorry, different address on the tax return. So stay away from day calculations, keep it to the months, but they don't have to be consecutive. So that's where I really, push my clients. And it's a good planning point with your clients too, when it comes to this exclusion, making sure that they do things properly, because it could be a situation where they are a month short and they sell too quick, things of that nature. One of the big things on section 121 exclusion, especially here in Southern California, is we end up with real estate with big gains. And you'll have somebody that's owned a property for 30 or 40 years. And you have to ask them, the 500,000 might not cover it. And so then you got to get into improvement. And what do you do there when they've owned a property for 30 years? I start with what they can document, and you can add that to basis, anything that's a, capital improvement. As far as what's a capital improvement, the way the IRS defines it is anything that increases the home's value. And so the only thing that I really cut out is exterior painting. If they painted the whole outside, I won't count that. As far as anything else goes, or when I'm working with my clients, I tell them like, hey, if you want to paint a room, redo the room. If the cost of the painting's in a remodel, then technically it's an improvement. So standalone painting of just one room, that's maintenance. Painting the exterior is maintenance, unless they're changing to like siding or going from siding to paint or paint to stucco and then repainting. You really got to get into the nitty gritty with your clients on what they did and try to mold those into things that would be considered capital improvements. Now, a lot of the times from things 20-30 years ago, they won't have receipts for it. In lieu of that, you can use the Cohan rule. Who's familiar with the Cohan rule? All right, Grace is. David, have you heard of it? Cohan rule, huge. Cohan rule is the thing that says as long as you have a reasonable basis and a reasonable estimation, you can use those expenses. It goes for, it's basically a guy, it was either in the 20s or the 30s. He filed a Schedule C and didn't have one single receipt, but he had good explanations on every deduction that he took. So as long as you're not completely off base, you can usually get it through audit using the Cohan rule. So what I do is I will, hopefully you get a hold of your client before they sell. I'll have them take pictures of everything that we're claiming is a capital improvement. Like if they redid a bathroom, redid a kitchen, it's like, okay, take a picture of the kitchen. You can tell from the photo that if they bought the house in 1965, the kitchen looks brand new, or maybe only 10 years old. So, and then back up to that would be either get a contractor buddy or something to come up with like an estimate of what that would have cost, or at the time, my clients be like, I pulled out a $30,000 home equity line of credit. We redid the kitchen. So if you've got a picture of the new kitchen, even if it's 20 years old, and then some type of documentation that they pulled 50 grand out on a HELOC, okay, they got a $50,000 kitchen. You just need to follow these steps of creating a reasonable basis of why you're adding that to the basis of the home, where you can't just pull numbers out of thin air. You got to have something. If they redid their furnace and air conditioner 15 years ago, maybe they still have the manual. At least you got the make and model of it and everything else, and you can come up with, it was a $17,000 unit. So when your client, when the gain exceeds the full 500,000, you really want to dig into these with your client and make sure that you can, get the basis up as high as you can through the improvements, because they forget, they're terrible with information. They probably didn't keep the receipts. All my current clients, I mean, we put in our questionnaire, and we instruct our clients the whole time they're with us to save all home improvements, everything else. So, but a lot of the times we get a new client in, something to that extent. And so, but the Cohan rule can be your best friend. So when you're helping people to increase the basis of the home, go through a checklist with them of every room that they remodeled. What did they change? Did they do a new roof? Did they do new plumbing? Did they do new heating, air conditioning? Did they redo the backyard? Landscaping counts, those things of those nature, and then they can pull out, either if they don't have receipts, then come up with the reasonable estimate of what it would have cost and add that into basis. I won't.
Quick question.
Yes.
If they could go back, let's say they could go back through their Home Depot statement and start pulling it out. Do you have them do that, or would you use a Cohan rule for efficiency sake?
I mean, it depends. If you're getting down into like, I bought an $25 2x4. I'm not gonna worry about that. Like if they redid the bathroom and they're like, we paid off, let's say they got the Home Depot things, and over the course of the 4-month period they paid off like $19,000 in Home Depot credit card bills. I'm just gonna take the total. I'm not, because it's something that's got to extend the useful life of the house, as well as potentially increase the value as well. So it's got to be something substantial. I'm not going to get into each and every light switch.
I have one other question. So had some pretty bad hailstorms lately here.
Mhm.
And so when they're redoing the roof, they're looking at adding better quality shingles to kind of mitigate some of that damage in the future. So then does the cost of my deductible kind of weigh into
Yes.
it at all?
Yeah,
Okay,
yeah, the cost of the deductible would be the cost of the improvement. And then if they had to pay of anything on top of that, because they're improving it over the existing. And so then the deductible would go into it. Now you can't take the amount that the insurance, you're not claiming that as income, so you can't take the amount that the insurance paid.
so would it be a ratio of the total expenses versus the expenses specifically associated with those shingles?
Depending on, I would take the full, if insurance pays for the whole thing, you're going to be stuck with the deductible anyway.
Right.
So, but
Okay.
so, and then if they do anything on top of that from hail damage, if it's something that maybe the insurance didn't cover and, you know, they improved it, then I would take that as well. And so like, let's say like the cars got damaged, so they put a carport in, you know, you're going to take the carport as a capital improvement. And so I would definitely add that in. So you really got to push your clients on this one because it saves them a lot of money. And if your clients are anything like mine, they get very just, well, I don't know, you know, and they're like, maybe that it's like, no, we need to focus and what did you do? You know, and if it boils down to be like how many rooms are in the home, go over each room, have them think back to what they did. You know, maybe a lot of them I had them, you know, they tore down wood paneling. And so, but and pictures can go a long way, especially in audit. And then hopefully they got a contractor buddy or something else that would draw some kind of proposal of, hey, it would have cost this if I did it. So so you should be good there, but you definitely want to have, you got to have something. There's got to be some kind of substance on how you came up with it. You can't just be like, oh, we're 60 grand shy on basis and just throw in 65,000. Then doesn't work that way. You can get in trouble for doing that. Here's another one that I used that I didn't know before I actually used it and looking on it. Adjacent land counts as long as it's touching. As long as, so let's say your client owns a principal residence and it's on half an acre, but then they own, you know, a 2 acre dirt lot behind it or next to it, or as long as a corner of it is touching somewhere, you can pull that property in to the section 121 exclusion, even though they weren't using that parcel as a principal residence. It may have just been a dirt lot. I used it for a client of mine that was in Tennessee, and he used it. He didn't use any of them for, you know, principal residence, but he had several different parcels around his that he owned, and so we were able to pull it on.